Hey guys, I'm Miles, the research lead at Denzity, and today I want to share with you our findings about the UK and its real estate markets. So the UK is a massive country with lots of different options for property investment. And right now the market is being driven by many different trends. First off, demand is far greater than supply. Between huge amounts of immigration and a large amount of foreign property buyers, many people are looking to buy residential and other properties in the UK. On top of that, London is a strong financial center, which has historically been a right place for property investment. Recently, there's also been a stamp duty vacation, meaning that property buyers can save up to £15,000 on their purchase. The government is also investing a lot in transport infrastructure. Just in the last few weeks, the minister has announced hundreds of millions of pounds going into transport railways, building new stations. And last but not least, there's a massive mortgage program where the government is helping first-time home buyers subsidize almost 95% of the housing costs. So these are a few of the many trends that anyone who's interested in buying property in the UK should be aware of. But on top of that, before making your purchase, you need to think about what sort of investor you are. When it comes to property, do you want capital appreciation or do you want income generating assets? So capital appreciation is more for large metro areas, city centers, property that's gonna go up in value over the next few years. Income generating assets, however, produce a higher yield. So in other words, they give you more bang for your buck or a higher rental income based on the property you purchased. And if you want more income generating assets, not focusing as much on capital appreciation, you might look outside of city centers, along commuter railway lines or smaller cities and towns. These would be the two main investor types. To give you an example, a higher yield might be something like 4 or even up to 6%. And there you will find, Birmingham, Liverpool, more commuter cities that don't have the same ultra expensive metro areas. Meanwhile, in London, it's a lot more usual to see 2%. Although in those 2% yield properties, you'll have a much higher appreciation of the actual property. So let's break it down into the 4 main cities that we're looking at in this episode. First off, we have London. So as I said before, it's the most popular real estate market. In London, you'll find the highest amount of capital appreciation, aka your property increasing in value over time, but it's also the most expensive to break into. As far as rental goes, you won't see as great a yield. So to stress, low yield, but high capital value. If you want more income generation, you might look to other cities. Enter Birmingham and Manchester. Both will say they're the UK's second city, and they both have pros and cons in and of themselves. There, property won't have the same capital appreciation as London, but you will probably make more income from the rent. To note, Birmingham also has a new high-speed rail connection to London, of which commuters can get to the capital in under an hour. For this same reason, many companies are moving their back office staff or business processing operations, BPO, out to Birmingham. For example, Deutsche Bank, HSBC, many others. As far as Manchester goes, there's lots of new developments. We're having some skyrise projects coming up to completion in the next few years, which means that Manchester is bound to see a large increase in supply. As the 4th final shout out, we want to mention Liverpool, which has gained a lot of energy, especially in Hong Kong, because of its lower price and break-in point. Again, Liverpool doesn't have as high capital appreciation and therefore break-in cost, but you're bound to see stronger income generation through a higher yield, especially when compared to the more expensive neighborhoods of London. But with so much property to purchase and with so many different sub-markets, how do you actually go about doing that? As far as all the due diligence and compliance is concerned, at Denzity, we've helped by breaking down the main taxes that you can expect. Income tax, corporation tax, capital gains tax, stamp duty, and ADT, which is annual tax on enveloped dwellings. First off, income tax. This varies, of course, depending on your income. The first bracket can see a 20% corporation tax. Corporate tax is about 19%. And then also capital gains tax for corporates is the same rate. As far as capital gains tax goes, it's based on the proceeds that you make from any sale. You can expect about 18% on capital gains tax, or with a heavier sale, 28%. For stamp duty, this is the transaction tax of purchasing property. Depending on the property value, it can be anywhere from 2 to 12%. To note, the UK's 2021 stamp duty holiday is actually expiring soon, meaning that new property purchasers won't be able to get the tax discount that they could have been enjoying these last few months. Lastly, we have ATD, which is annual tax on enveloped dwellings. This one also varies highly. It can be anything from £3,000 to £4,000, all the way up to over £200,000. There's a lot to navigate here, and at Denzity, we want to give you some tips that you should be aware of. First off, you need to keep a very tight record of all expenses to set against future income tax, because any sort of expenses that you incur while managing or purchasing or selling property, you have the potential to reduce any of these 5 taxes that we've talked about. On top of that, if you buy to let, there are also certain relief plans in place that can help you save on taxes, as well as a mortgage interest rate that can be more favorable to you depending on your financial position. To recap, we've covered many things about the UK property market in this short insight video. First off, we talked about what's driving demand. What are the factors behind the market that are responsible for the prices we see in the different submarkets? Second off, we talked about how to determine your own investment strategy. Do you want income generating assets, or do you want capital appreciation? In a perfect world, you can get both, but we cannot always choose that. Also, finding property. Do you want main metro areas or smaller cities and towns along commuter lines, rural centers? We also discussed property taxes in the UK. For insights like this and more, tune into future Denzity Insight videos and stay tuned for our articles, where we'll be releasing more content on investment-based news.
Thanks for watching. What do you think of this episode? Please let us know in the comment below, and be sure to hit the subscribe button to keep in touch with us for upcoming videos. But before we go, I want to give a big shout out to Patina Design Lab. They're the ones who help us in making our brand, art direction, as well as these videos. They are a strategic design consultancy firm to help businesses with a wide range of design services, from industrial design, branding, graphic design, art direction, content creation, and many more. They are a very talented bunch, and I urge you to check out their website for their work. That's all for today, and see you next time. Cheers.